Good morning from Los Angeles, California. How's everybody doing? Welcome to Power Hour Fridays, every Friday at 10 a.m. Pacific, 1 p.m. Eastern. I may add another Power Hour on Mondays, but we're considering it at the moment. However, what a 2 weeks it has been, right? A lot of activity, a lot of a massive sell-off, which I'll talk about some of the reasons why, and then market took it in stride and came back. I have some good news and some bad news. So, which one do you guys want first? I'll give you the good news. Good news is I'm here. I have survived the volatility. The bad news is this has been coming, and this is what I've been dreading for the last, I don't know, 6 months. And to my procrastination, I did not do it in advance, but then um, I have to do it now. How I do at the end of the show. I do watch list and charts and go through my personal watch list for the upcoming week. Well, I'm going to do it, but I'm going to do it in a way that you guys may not enjoy. However, if you have any questions, please save them for later. So, for some of you who are new to this channel, from my followers at After Hour, the way we do it is I talk about the macroeconomy in general, which I think is very important. I mean, and we know what happened yesterday, right? Retail sales came out, and what happened? Market took off, and inflation news came out on Wednesday. What happened? Market took off. So the macroeconomy is something you guys need to really pay attention to. Besides, obviously, technical analysis, you have to be, like me. I call myself a techno fundamentalist. I do pay attention to charts, obviously. I do believe that they have some relevance, although when the markets are moving the way they are, technical analysis is out of the window, and then that's why you rely on your fundamentals. What is happening? Why are these moves taking place, right? And my goal is to inform and educate. So if you guys are getting something out of it, I'm glad. I mean, very appreciative of the support. I think I hit 1,100 subscribers. So if you haven't subscribed, please subscribe, put a thumbs up. If you're missing this live stream, you can always watch a replay. The channel is on YouTube, obviously, at Sergio Avedian. My goal is to inform and educate, and if I can help you guys with that, that's it. That's about it. Because YouTube money is not what everybody thinks it is. The other thing that I want to mention here is my email is sergio@sergioavedian.com. So if you have any questions, you guys can obviously forward those there. I may not get to them as fast as you guys like, but then I'm inundated with emails, so you have to understand. So I'm going to go through the same thing with pretty much no charts. I do have charts, don't get me wrong. But what you guys have seen for the past couple of months with my Schwab account, and I have also shared my personal Schwab account with you guys, and my little Robinhood $1,000 account challenge. That's still there. That's going on. Did that survive the ups and downs? Yes, I was kind of positioned for market going down. Actually, I should have made a lot more than what I did, but again, the little Robinhood account has so many restrictions on it, as far as day trading, pattern day trader rules, and things like that, that it's really, really difficult to start at $1,000. I'm still at about 3,300, so right about 32x, 200%. It's pretty good. I was over 4 actually, but then I took a nab on the short side on Thursday after the inflation data, and I got a little smashed. So even I get smashed, people. So don't worry if you're gay, if you got smashed in this. Another thing is, paying attention to what's going on in the country. Obviously, we're in an election year, right? We need to pay attention to a lot of things as traders or investors. And, please just, create, when you're having dinner with your family, talk about these issues, talk about the macroeconomic conditions, talk about inflation, talk about the Federal Reserve, talk about all these things. Yes, they may be boring to a lot of people, but then that's what your life is ruled by, right? People in Washington and people at the Federal Reserve. So I'm hoping that you guys will excuse me for not having charts and having my setup. Truly, I hate Thinkorswim. They forced me to migrate my Schwab account to accounts actually from my trading account. I need to be on top of it, right? So Thinkorswim is a completely new platform. I've been used to Schwab Street Smart Pro and on my trading account for over a decade. And you guys can understand that's like moving a house, right? You have collected so much garbage over the last decade that you don't even know where what is. And then you move to a new house, you have no clue where what is. We have no clue where to place what. But I will learn. I have the weekend to update everything and migrate myself to Thinkorswim. It's not the best platform in the world. I realize it. I may have to actually take some other action and simplify my life a little bit. I don't mind learning a new platform, look, they all do the same thing. They buy, sell, charts, this and that. But what they don't, the problem is I'm used to transacting really quickly. And, I'm used to certain labels and buttons to be where they were for a decade or more. Now I have to go figure it out. I have to basically make muscle memory out of it. And it's really going to be a lot of work this weekend for next week's Power Hour for the charts and everything else be ready. Okay, Vic says, okay, keep the questions for later. I will answer all the questions as I usually do. Anyway, so let's get into the macroeconomic conditions. Inflation came out. It seems like inflation is getting tamed, according to the Federal Reserve. That was the news on Friday. And yesterday's retail sales lit another fire under the market. And so these are the inflation numbers. And as I said, I follow the Kobisi letter. I think it's wonderful. I think it's amazing. They do summarize a lot of what's going on. So I encourage you to do it. They're on Twitter. So if I'm also on Twitter, quite active. There is a disconnect between what the Federal Reserve brings out as far as inflation numbers are concerned and reality. Reality is we're living day to day. The inflation numbers that came out that supposedly they were tame were X food and energy. How many of us don't eat and how many of us use energy as far as gas in our cars and heating, and cooling and all that stuff, right? So I call it, hocus pocus, because there is a reality and there is the academic side of the story that says, oh, inflation is wonderful. Now we're going to start cutting rates. I'm going like, okay, cool. So while the July CPI inflation is at 2.9%, inflation is much higher in basic necessities. Well, let's talk about those basic necessities. Number one, we deal with it. All of us have cars, probably, and we deal with it. We've been dealing with it. This is just for 2024. Car insurance inflation up 18.6%. What happened to 2.9? Transportation inflation up 8.8%. Hospital services inflation up 6.1%. Homeowner inflation 5.3%. Rent inflation 5.1%. These are the things. These are the necessities, right? Electricity inflation 4.9%. Car repair inflation 4.6%. Food away from home inflation when we go out to eat. Nowadays when you go out to a McDonald's as a family of four, it's $100. And that's not even food. I consider that, right? You go some decent restaurant, it's definitely two bills. So are we making enough to keep pace with all these numbers? I don't think we are. I think adjusted to inflation, our earnings are down quite a lot. So since January 2020, so inflation is what? Inflation is too many dollars chasing too few goods, as a layman's term. So since 2020, the US dollar has lost 25% of its purchasing power. We talked about this, right? Every year, the US dollar loses. So that if you had $100 in 2020, today it's worth 75. So you're losing a lot of buying power, purchasing power when it comes to that, okay? And that's inflation eroding your buying power. That's inflation eating away, your dollars. So since January 2020, the US dollar has lost 25% of its purchasing power. Inflation has effectively been compounding for 3 consecutive years, and prices are still rising. Although the government says inflation is under control, it's being tamed. Hey, no big deal. How much have prices increased over the last 24 years? So according to Kobesi letter, U.S. hospital services prices have skyrocketed 250. This is our healthcare people, skyrocketed 256% since the beginning of the century. At the same time, college tuition and fees are up 188 and 158% respectively. The prices of childcare, nursery school, and medical care services rose by 139 and 136%. On the other hand, TVs, toys, computer software prices declined by 98, 74, and 74%. That is true, right? Not everything is going up. However, the basic necessities that we need, such as rent, such as housing, such as transportation, such as car maintenance, such as car insurance, are through the roof. So, the disconnect is that the Federal Reserve brings out looks into the basket of inflation, and they consider certain things in there that is not really necessities to us, right? And I don't buy it. I'm not buying it. I will never buy it. I always say these people probably don't have real lives. They're so ingrained in what they do in Washington and at the Fed that the average American is hurting. I mean, there is talk of a recession. By the way, when I'm talking about the individual stocks or whatever, as much as I can with my new charts, you guys, I'll talk about that. And here's the chart that I think is very, very, very telling. So to put this in perspective, average hourly wages are up 119% since 2000, but everything else that is necessities is up a lot more than that. So that's why I've been saying for the last 2-3 months that your earnings are not keeping pace with inflation. And these are all on Twitter, by the way. The Kobesi letter, please go. It's a free newsletter. You guys should take a look at it. I mean, they do put these wonderful charts together. So if you guys can see, all the lines going from the zero level, which is right about 3/4 way down, up, right? Is inflation hurting us, and the rest is on items that inflation is tame, or actually prices are going down. So how many cell phones, right, do we buy? If we have an upgrade every 2 years, we buy one, the price is less. Is it really though? I mean, right? They have these 3-year deals now that you have to pay $35 for an iPhone or a Samsung or whatever, or an Android, that you're tied up into something for 3 years, or a cell phone is at least $1,000 to $1,400 these days, right? But a lot higher than what it was 3 years ago, 4 years ago, 5 years ago. But everything else that we use as basic necessities has gone up. And I don't believe inflation is 2.9%. If you believe inflation is 2.9%, I have a bridge to sell you in Alaska. So that's one of our topics. I mean, talk to me about inflation. I'm reasonably well-to-do, but even I can't keep pace with the inflation, right? Especially auto insurance rates. I mean, holy crap. I live in California. I've been with State Farm for 20 years, including my homeowner's insurance and everything else. Even as a basket, they just increased my premiums by 40%, right? Well, that 40% is a lot on 3 cars that we have, right? And am I making 40% more than last year? I don't think so. I don't think anybody is making 40% more than last year. But one other thing that you guys know how much I respect and agree with Elon Musk when it comes to what he says, and I couldn't say it myself better, honestly. So he had a tweet last week that he says the rise in price inflation is caused by government overspending, which increases the amount of money faster than the increase in goods and services output. 100% agree. I talk about the deficit quite a bit. We just hit $35 trillion, right? Every 100 days, our deficit is going up by $1 trillion. Every 100 days, right? So we just broke 35, and we're going to be at 36 in 100 days. and we're going to be 37 in another 100 days. So I couldn't have said this better myself. And government overspending is absolutely killing the average American, right? Because they have not seen a dollar that they don't like. They take it and they spend it before they even take it. And then the reason for, and that's why we have the 35 trillion in federal deficit. Okay. Um, I agree with Elon Musk. By the way, I don't know if any of you watched Trump and Elon Musk's Spaces where it crashed, and Elon said that it was due to a DDoS attack. I don't know about that. I mean, I take his word. But the point is that, he has mentioned this on a couple of other interviews that he has done, that he wouldn't mind taking a role if Trump wins in the administration as a government efficiency expert. I mean, that would be amazing, right? And we know how efficiently he runs his companies. I mean, that would be wonderful. Yeah. I bet he does that for free as well, because I don't think he's doing it for the money. But somebody needs to be in charge of this stuff, right? They take the money they don't have, they spend. They take your tax dollars, they spend. They just keep spending. And what do? When they have a deficit, they print. Well, that's too many dollars chasing too few goods. That's the definition of inflation. Inflation was particularly bad during the COVID years. Yeah, because, it was a black swan event, and then they had to print $7-8 trillion, and that went into the economy. That automatically creates more inflation, as there was massive government spending, obviously, despite productivity plunging, as people were forced to stay home. This is further exacerbated by excess regulation, which prevents the market from solving an unmet need, housing in high demand areas, correct? And that's why we know what has happened. If you owned a house, it has doubled over the last 20, 25 years, 20 years, basically. Should it have? No, that's inflation right there. And I talk quite a bit about housing affordability in the past, and I probably will in the future. Occasionally, there's a monopolistic behavior by companies. Well, yeah, inflation helps companies actually, because they can raise pricing, because they're the service provider, they're the manufacturer of the goods. They can raise pricing, but then how many times they lower pricing to where it used to be 2-3 years ago? They never do, right? They raise it 30%, they cut it 5%, and make it look like, oh yeah, we're getting a bargain in whatever we're buying. We're not. My biggest example with this is, if I had $100 bill and went to Costco, which I love, amazing company, amazing management, 10 years ago, with my $100 bill, 10 years ago, I would have bought 12 items, because everything would be priced at $7.99-ish, $8.99-ish. Today, if I go to Costco with the same $100 bill, I'd be lucky to get out of there with 4 or 5 items, right? There is inflation for you. That's your buying power eroding continuously. And that's because of what's happening in Washington, and what's happening, monetary policy follows fiscal policy, and our fiscal policy is garbage. And, we have these wars, we send money all over the world. I mean, look, take care of your own house before you try to fix the rest of the world. Occasionally, the monopolistic behavior by companies, but this is relatively rare and usually only possible if those companies have gained control of their industry regulator. Yeah, I mean, he's talking a little bit about different issue here, but I do agree with him in general that inflation is definitely caused by government overspending, and which increases the amount of money faster than the increase in goods and services. I talked about this last week. There's a really great video that I put out. All this government spending, there has to be an ROI. There has to be a return on investment on the spending, right? So what is the return of investment? In the 30, 40, 50 years ago, when we spent $1 trillion, we got 4 trillions worth of economic output out of it, or GDP out of it. Okay, it was like 4-1. Going back to the World War, levels, time zones. That $1 trillion we spent to win the war created 10x return. Well, today, that $1 trillion we're spending, right, and creating the deficits, increasing into the deficits, is only creating about 56 cents. So that $1 is producing 56 cents worth of GDP. That's negative. Okay, it should be producing at least 1, if not 2 or 3 or 4x, right? I mean, I'm not against borrowing money. I'm not against that at all. I'm not against debt, but debt used properly is wonderful. But debt used improperly, like we're doing in our government, is absolute disaster. Okay, and I'm going to keep talking about this until I'm blue in the face, and then you guys will probably get tired of hearing it. But then it is reality, and use debt. I'm not against using debt, but if you're going to use debt, even on the smallest level as a credit card level, pay your bills at the end of the month, because if you carry balances, you're going to pay 40-50% interest, or if you're lucky, if your credit is amazing, maybe 25 to 30% interest. So use debt, but use it properly. So our third topic today is going to be, this is something, people call, socialistic. It's not socialistic. It's reality. Why does this happen? Why did the rich get richer faster than ever before? Well, there is a reason for that. The reason for that is they have holding power, number one, and they can borrow money at very, very, very low interest rates, or they did borrow money at absolute zero rate for the last 15 years, right? When we had ZIRP going on, zero interest rate policy, that's what they did. They borrowed and purchased assets, and then assets become rarer, right? That includes real estate, that includes stocks, that includes everything else. And then what happens, right? Their overall percentage of the wealth goes much higher compared to the average American. But then here's the deal, right? On this channel, what we're going to do is we're going to try to join the rich, right? We're going to try to figure it out in a way that, and how does that happen? That comes with compounding, right? And I talked about the rule of 72 with you guys in the past. That comes with compounding, and that starts with start investing, right? Because these people invest. When they borrow the money, they go buy real estate to create passive income. When they borrow the money, they go buy commercial real estate. They go buy, look what's happening, right? All the private equity funds have been buying up houses. People like Bezos's and BlackRock's, right? All they have done is buy houses, and then they have controlling the rents, and then they're creating, income sources for themselves. And then so quick example of this would be this, right? Okay, so Fed raised the rates to 5% on short-term T-bills over the last 2 years. If somebody had $100 million, they're getting $5 million in interest on that. Well, what do you think they're doing with that $5 million? Do you think they're going blowing it? Yeah, some people are, but mostly the rich are getting richer by taking that $5 million and investing it. Okay. And so it works for both of them. When the rates are high, it works for them because their return on the cash that they're holding is going through the roof. And then when the interest rates are zero, they have the ability to borrow at zero and then invest in assets that can return them 6, 8, 10, 12%. And that's why the rich are getting richer. So the top 40% U.S. income earners hold 83% of the total net worth in the country. Think about this, people. Top 40%. So how do we get into that top 40%? You start investing. You start doing exactly what they're doing. There is a reason they're successful. There's a reason they own 83% of the total net worth in the country. Top 20% account for 71% of the total net worth, up 10 percentage points over the last 2 decades. Why? Zero interest rate, ZIRP policy. Borrow at zero, invest at 5, 6, 8, 10. And every 6 years, if you're getting 12%, every 6 years, you're doubling, right? That's the compounding part. On the other hand, the bottom 40% of the income household hold only 8% of the wealth. See what's happening here, right? So if you're in the bottom 40%, you need to put your house in order. Obviously, you need to have a budget. Don't borrow money that you cannot pay back. Don't buy shit that you don't need. So moreover, the bottom 20% of earners reflect just 3% of U.S. wealth, okay? So you guys have to understand what's going on here and join the party, okay? Again, a lot of people tell me, "Oh, Sergio, I'm only like 55 years old. I'm too old to invest." No. It's never too late to start investing. I talked about DCA, right? Dollar cost averaging. You don't have to be a stock jockey like me. You can just invest long term. You can do both. You can have a long term portfolio and you can have a short term portfolio. So over the last few years, the rich have gotten richer. Absolutely. Most consumers are struggling. That's a fact. But look at the chart where I put the big red oval, right? Look what is happening, right? The top quintile of income earners hold 71% of net wealth in Q1 2024. And it keeps going the higher. So, for example, we had the massive 10, 12, 14% pullback in NASDAQ and 10% almost on the S&P 500. That was your time right there. It gave you an opportunity to get into, if you never invested before, start buying some ETFs or, I talked about high yield dividend funds and things like that. I mean, you have to start. The start is the tough part. Once you start, you're on your way. So yeah, rich are getting richer. A lot of you are going to say, well, yeah, the government's set up that way, this and that. Yeah, but forget the government. You're your own government. Okay. I am my own government here in my house. This is my country. You got to run your country properly. Okay. And if you don't, you're going to be just in the same boat as the federal government, which is 35 trillion in debt, right? If you run your country properly, you have it definitely, especially in this country, unlike other places around the world, you have a chance here in this country to join that, top 40 or top 20%. And by the way, people think, always think of Bezos's and Gates and Musk's about that. No, it's not about trillions. You all should understand, if you are earning $200,000 in this country per year, you're in the top 2% of earners. This is not a joke. You guys can go Google that. 200,000 is in the top 2%. 100,000 is in the top 5%. You may all think, oh, it's not that much money. I'm like, yeah, go do it. And, get into that top 20, top 40% and start accumulating assets. It could be all kinds of assets. It could be, obviously a lot of people do it in real estate because then let's say you go buy an investment property, rent it out. Well, it's creating cash flow for you, right? That's how you compound. That's how you grow your wealth. And so that's our topic for the day. Our fourth topic is going to be talking about Warren Buffett. What did Warren Buffett do right before the market crashed 2 weeks ago, right? He sold 50% of his Apple holdings. Right, wrong, sideways, doesn't make any difference. Do I like Warren Buffett? Absolutely. I think he's a legend. Can he do what he did 30, 40 years ago today? Probably not, right? But he's the buy and hold guru, right? Am I in that camp? Yes, I have an investment account that I like, long-term assets that I DCA, dollar cost average. But he's signaling something here, and he signaled the same thing in 2005. What is he signaling? So Berkshire Hathaway is his, obviously, baby, right? He has created billionaires and millionaires by the hundreds and thousands, through Berkshire Hathaway. He is the, guru in long-term investing, okay? But he's been selling Apple. He's been selling a lot of these, mega 7 names. Not that he owns any, but he had bought Apple. He had a massive, massive stake in it. Berkshire Hathaway started selling Apple, and market crashed afterwards. I mean, was it related? Probably not. But Warren Buffett's Berkshire Hathaway cash position relative to total assets spiked to 25% in Q2 2024, the most in the last 24 years, as you guys can see. And then, if you guys can see, I mean, this chart goes from 2000. So we had the, NASDAQ bubble in 2000, right? And then he kept raising cash all the way to 2005. And then this is right before it was at its peak. He had 25% cash of his total holdings in cash. He was ready to buy. And what did he do? He heavily bought right into the 2008 financial crisis. I mean, we know the legendary deals he did with Goldman Sachs and a lot of the financials, a lot of the banks. He literally saved the system, to be honest with you, besides Fed's TARP. And, he's been kind of going steady, but constantly kind of raising cash as a percentage of total portfolio value. Well, with this Apple sale in Q2, as of June 30th, 2024, his cash hoard now, I think, is over $220 billion. It was like 170, and he sold like $40 billion worth of Apple. Don't quote me on that. I may be wrong, but I know before he sold the Apple stake, the massive Apple stake, he had about 176 billion in cash. And then in every interview, they ask him, I go, why are you sitting on cash? Cash is trash. He goes, not really. He goes, I'm earning 5%. Actually, there is an article that came out a couple of weeks ago. He actually owns more U.S. Treasury bills than the Treasury itself, because that's where the money goes. It's earning 5% interest on short-term T-bills, weekly, monthly T-bills. Think about it, people, right? I mean, Warren Buffett owns more treasuries than T-bills than the Treasury itself. So he's enjoying the 4 or 5% return, because the reason he's raising cash, number one, last time he raised cash, by the way, at its peak, it was June 2005. What happened in 2008? Well, we know what happened. So is this a good recession indicator? Probably not. But then the reason he's in this much cash is because he says he doesn't see any value, right, in individual stocks. Although the quarterly holdings came out, and then he invested, to him it's peanuts. It was like $260-70 million worth in Ulta Beauty, and then stock jumped obviously 25%. But he does shuffle the portfolio quite often. He adds and subtracts. He's been also selling Bank of America. So to put this in perspective, the company's cash pile to total assets reached 24.5% in Q2 2005 and remained elevated until 2007. And then the financial crisis hit, and then he put all that money to work, as you guys can see in the chart. There it is. I was actually short. Cash and cash equivalents and short-term treasuries held by Berkshire Hathaway spiked by 88 billion to a new all-time high of 277 billion. Imagine that, holding 277 billion, in cash. And is Buffett turning bearish? I don't know about Buffett turning bearish or not, but Buffett is definitely saying, look, I like cash here more than I like stocks. I mean, having somebody's portfolio 25% in cash is pretty high, actually. I'm right now, I'm at like 40% cash, but I'm a trader. So tomorrow that could go down to zero. So our next topic is going to be the elections, right? Okay, so what happened with the elections, right? We had a disastrous debate between Biden and Trump. And then Biden, I don't know if that was a debate, that poor man they put up there as the sacrificial lamb. And but the question here is going to be, who's better for the markets? Democrats are better for the markets, or Republicans are better for the markets? A lot of people are going to say Republicans are better for the markets, and you would be wrong, because under the Democratic administrations, actually, the stock markets have done better than the Republican administrations. Now, I'm talking about the benchmark. I'm talking about the S&P 500. Individual stocks, I don't know. However, as a benchmark, S&P 500 has done as good or better than the Republican administrations. But what has happened is that before they put Biden into retirement, poor man, I really feel bad for him. And, they made a scapegoat out of him, obviously, but then he's definitely not in shape to run this country or be president for another 4 years. So they slid him to second base and then put Kamala Harris up there against Donald Trump. And before that happened, Donald Trump had a massive lead over Biden. Massive, right? And even the stock market the next day went up just for the fact that they thought Trump was a shoo-in to win the election. Well, this is as of yesterday. I mean, look, you guys got to take these polls with a grain of salt, okay? I don't buy any of these things, but I'll put it up just to have a conversation. 53% Kamala Harris, 45% Trump. Kamala is in the lead. Now, there's predictive websites, by the way, that you guys can even go bet on that, by the way, okay? I'm not telling you to do it. I'm not going to do it, obviously, because nobody knows what's going to happen. I mean, Trump could have been dead, actually, but the point is Kamala Harris is coming on strong, and she picked as vice president Governor Walz from Minnesota, and they hit the campaign trail, and it seems like the race is going to be a lot tighter than people think, because if it was a Biden-Trump race, Trump was a shoo-in, I'm pretty sure. So prediction markets are now showing 53% chance of Kamala Harris winning the 2024 election. It's Polymarket, so you guys can go to Polymarket and bet on it if you're degenerates. These markets are different than polls, and this is actually a live marketplace. It's like a bookie website, for lack of a better word. So who's better, right? Who's better for the markets? Is Trump going to be better for the markets, or Kamala is going to be better for the markets? First of all, in election years, markets do reasonably well, okay? There is a cyclical election year process that we go through, and the market had this year, before that little swoon that we had, S&P 500 and the NASDAQ is up a lot more than the yearly benchmarks, over 20%. Usually it's 8 to 10, 11% per year on average, right? So what does that say for the rest of the year? Is the market going to keep going higher? Is it going to go make new highs? A lot of the predictions are that it is. But what happened is that we had that, nosebleed of a fall. Like I always say to you guys, what do I say? Market steps, that takes the stairs up and then takes the express elevator down. And that's what happened. That was an express elevator going down. I mean, oddly enough, look, if you guys been watching me long enough, 2, 3, 4 weeks before then, I've been saying, I said, this is how you short the market. This is how you take advantage when things are going down. I talked about volatility index, watch the volatility index. It went from 12 to 65 and it's back to 15. That is, by the way, the volatility index's move was the volatility picking up and volatility getting crushed was the fastest it has ever happened as long as you guys can go back on the volatility index, okay? But then, as I always have said before, last 3 months, if you guys are watching me, I said the market is a good predictor of the economy, meaning markets are 6 to 8 months ahead. Is the market forecasting a recession? Well, this is what happened. So until that mini crash that we had, which I'm going to talk about the reason on the next segment, is we had soft landing planned in, priced into the markets. Fed is doing a great job lowering inflation. They're going to start cutting rates shortly, and everything is fine. Well, and then overnight, the sentiment went from soft landing to recession. And that's what happens, right? And then after the two announcements this week on inflation and retail sales, recession was kicked out, and then now we're back to soft landing. That's why we're getting that V bottom that we did. It's called a V bottom. It literally looks like this. It crashes and comes right back, snaps right back up. I will give you my opinion at the end when I'm using my half-ass charts on Thinkorswim. So what has happened is that due to the reason of that crash that we had, because I've been talking about the softening economy with you guys for the last 2 months, right? The indicators are not there. Unemployment's going up. Again, this is all about macroeconomy, but you have to factor in fundamentals into your technicals. And when the market sold off and recession was kind of predicted, you went from soft landing to recession. What happened is interest rate futures are now pricing 8 Fed cuts over the next 12 months. That's a lot. That may bring back inflation, but we'll find out. But, market 6 to 8 months ahead, sell-offs happen 6 to 8 months before earnings start declining. And you guys got to watch out. I mean, over the last 60 years, every time the market expected 200 basis points of rate cuts, a recession in the U.S. followed within several months. Now, a lot of people are going to ask, because I'm watching the chat go around, I'm not reading it yet, but I'll bet you some of you ask, aren't low interest rates good for the economy? Absolutely are, but with a lag effect. Just like the higher interest rates took the toll on the economy, but there was a lag of a year, right? Because when the Fed raised the rates, it took them a year to raise them from 0 to 5%. And then the effect took place, and then they wanted to kill inflation that they created in 2000 during COVID in 2020 by raising the rates. Well, the lag effect is over now. So now I said this, it's public. You guys can go watch the previous videos. I said, when they start cutting rates, the market actually will decline. The reason for that is Fed never cuts rates in a good economy. Fed, interest rate cuts or increases are the brake and the gasoline of the economy. Okay, that's how it works. So right now, Fed is thinking economy is slowing down to a point that I have to cut interest rates to give the economy some juice, because if they wait too long, which I think they're behind the curve as usual, they probably should have cut it already. But then by the time they start cutting, the economy is already in a recession, right? You understand the lag effect now? And the interest rate futures pricing 8 Fed rate cuts is up from 4. So that doubled in the next 12 months already. You can watch that. They're called the dot plots. You guys can go figure that out. I don't think 8 is going to be there. I think it's going to be less than 8, but I think it's going to be more than 4. First one coming probably in September after the Fed meeting. And there's another catalyst actually on August 23rd. There is a massive meeting where the Fed is going to the Fed chairman actually is going to have a news conference. So, he may hint, because what they do is they kind of hint about these things. Yeah, I think, are we going to in a recession? I think we are. Is the market going to follow? Yes, I think it will. Is my bias still negative? Yes, it is. And if they start cutting the rates really aggressively, the market's going to get a signal from the interest rate cuts that things are not as well as they think. And I think earnings estimates are too high. Again, you can follow this 3 months, 6 months from now. If I'm still doing this, you guys will hold me to it. So that's where what my tea leaves are saying at the moment. And so this is the interest rate futures are pricing a recession. Well, recession may be a difficult thing to gauge. There's many things you have to look into it, but yeah. And when according to this chart, if you guys look at it, when the market is predicting heavy interest rate cuts in the form of quarter or half points, and it's predicted 8 of them are going to be there to the tune of 200 basis points, interest rate markets are predicting a recession. So we will find out in the next 3 to 6 months if the economic data that's coming out is supportive of a recession or not. But we'll talk more about that. The next one that I'm going to talk about. Okay, so we had that crash last Monday. The Bloody Monday, I called it. I was tweeting like my butt off, but there was something called the yen carry trade, and I talked about actually on the last Power Hour about it, but I didn't have these graphs because Chris was on vacation. So, all right. So, what is the yen carry trade? Okay, let's understand that. Let's go quickly. If you guys missed last week's, please go watch Power Hour. I talked quite a bit about it. So there's different currencies around the world, as we know. There's euros, there's yens, there's drachmas. Drachmas. There is the ruble and obviously the US dollar, right? The New Zealand dollar, Canadian dollar, Australian dollar. There's many different currencies that people use, right, in their countries. So US dollar obviously is the top currency, the top dog when it comes to currencies, right? It's the reserve currency of the world. Although a lot of the BRICS petrodollars don't exist anymore. The Saudis are looking to trade in their own currencies, with the yuans, Chinese yuan, and so there's some shift happening, but I don't think the US dollar is going to lose its reserve currency status. If it does, we're in deep trouble. Okay, I doubt that it will, though. So what happened is that we have the Japanese yen on one end, and we have the US dollar on one end. So not only there's different currencies, but there's different interest rates that are set in these countries. The Japanese had a deflation problem, and they had 0 interest rates for the last 25 years, 30 years. Tried to bring their economy out of the hole that it's in. Okay. So when the Japanese interest rates are at 0, and we had ZIRP as well, but then what did the Federal Reserve do? The Federal Reserve increased the US rates to 5%, short-term rates. Japanese were still 0. Now we have 0 and we have 5, right? So what do a lot of the hedge funds and private equity, and this includes a lot of people around the world, this is not just US, right? What do? What can you do? If you can, obviously. You have to have the mechanisms to do it. So what you do is you go, first of all, to borrow in Japan. You borrow in Japan, right, with Japanese yens. You can't borrow in US dollars. So there has to be this currency exchange, and that's the exchange rate, okay? Under the assumption that the exchange rate stays stable, which it has been, okay? In fact, the US dollar has gained due to the reason that we're raising rates and the Japanese are keeping it at 0. If you look at a Japanese US dollar exchange rate, US dollar has been gaining against the Japanese yen for the last 3 years, 2.5, 3 years. If you look at that chart, it's steadily gaining value against the Japanese yen. Okay, so what do? We go exchange our currency into Japanese yen. We go to Japanese banks or the government or their Federal Reserve. We borrow at 0 interest rates. Okay. Now, then we go back to the US, and then maybe we can buy a treasury bill with that at 5%. So we're automatically, that's called a carry trade. We're carrying a trade that's dependent on three things. One, exchange rate between the US dollar and the Japanese yen. Two, the difference between interest rates in two countries. This was being done, by the way, by a lot of different people all over the world, right? And then that's what it was called, the carry trade, right? Well, what happened is that this carry trade is into the trillions and trillions of dollars, okay? So before the flash crash that we had, now that I can call it a flash crash because we have come back, what happened is that the Japanese government, in their wisdom, after keeping the rates at zero for the last forever, they decided to increase the rates from 0 to 0.5%. Okay? Think about this now. At the same time, there is talk that we're going to cut the rates. So what is happening now that spread is kind of coming closer, right? Again, 0.5% is nothing to talk about. But if we start cutting rates and Japanese start increasing rates, so that 5% middle is not there anymore. It's shrinking. That's one. Two, the effect on the Japanese yen gaining against the US dollar was in such a nosebleed fashion. Literally, in a matter of 2 weeks, the Japanese yen gained close to 12% on the US dollar. Now, you guys got to think about this now. As I said, this transaction can only be done by exchanging your US dollars to Japanese yen and converting it back again to bring it home, right? So if you did this carry trade and you borrowed at 0 and invested at 5, but now your currency exchange lost you 12%, you're in a hole by 7%. And most of this carry trade, by the way, was done to buy the Mag 7, the equities, okay? So, well, now the currency risk is coming into play, because now when I exchange my US dollars to Japanese yen to do this trade, okay, everything was fine because it's stable. In fact, US dollar was gaining. I was fine. But then once I did this, I just lost on the exchange back to the US dollars 12%. Well, now I'm in toast. And these people do it with massive leverage, okay? So what happened? A lot of that got unwound, and that's why we had the flash crash. So how large is the yen carry trade? On Monday, global markets experienced significant losses due to growing fears that the yen carry trade is unwinding. Yes, and I'm going to show you guys a chart, and you guys will see what the correlation is between the carry trade and the US equities. According to Deutsche Bank, massive conglomerate in Germany, the yen carry trade amounts to a whopping $20 trillion. Think about this, people. Okay, this is what happens when the governments print money around the world and then put it into the economy. Well, that money chases return, and these are the risky things that they do, which will affect everybody's. Like, it will affect my 401k if the market tanks. Or 505% of Japanese GDP based on Japan's government balance sheet assets. Other estimates, they use Japanese banks' foreign lending data from the Bank of International Settlement show that it is $1 trillion. So the other thing that happened is that they were doing the same thing, the Japanese investors, right? They were borrowing in their own country, exchanging it to US dollars, coming here and buying stocks. The Japanese investors' net international investment, which size has grown to 3.4 trillion in Q1 of 2024. So they borrowed, the Japanese hedge funds and banks borrowed in their own country, came to the US and bought the Mag 7 or bought treasuries, right? The yen carry trade is massive, and that was the reason. Now, my opinion, is it over? No, I don't think it is over yet. I think, and then, it's kind of a feint, but you guys need to pay attention to this chart. There is I drew a long rectangular box on top of the chart, okay? Look where we had trouble when the Japanese carry trade, and the white bars, by the way, is the size of the Japanese carry trade, and superimposed on the white bars is a yellow line. It's kind of faint, but you guys will, maybe watch it later carefully. That's the equity market. That's the S&P 500, right? So every time that carry trade gets up close to the yellow, the red rectangular box I drew up there, what happens to the stock market? And it's when it starts getting unwounded, the market eats it, absolutely eats it, right? So and look where we are now as of last week and last month. Look, we're inside the red box now, and you guys can see what has happened with the yellow line going literally straight up. But the correlation is uncanny. You guys need to start paying attention to this. See, these are the things you guys are learning here that it wasn't in your thought process. What is the Japanese carry trade, and how does that affect my stock or in my Nvidia or my Apple? Well, that's how it is right there. So the first shot across the bow was Japanese carry trade. Part of it is being unwound. If it's $20 trillion, it's massive. I mean, we're looking some pain here, and we're looking some massive volatility coming up. So decades of the Bank of Japan's monetary policy easing created massive distortions in financial markets. 100% agree. And in fact, the reason that bloodbath ended was the Japanese Federal Reserve chairman said, we're not going to raise rates anymore, because what happened is that they raised the rates. The Japanese yen gained 12% on the US dollar. The carry trade started getting unwound, and they figured, holy crap, we shouldn't have done that, but then they did. Are they going to continue doing it? Well, time will tell, but the carry trade has a massive direct correlation between what happens in our stock markets. So that's the Japanese carry trade. I want to talk about 6 minutes on, a lot of people ask me questions about, Sergio, you're trading options. Great. What are you buying? How are you figuring this out? Okay, this is more of a evergreen kind of a topic. So when I first started the channel, I recommended you guys books. Hopefully you bought the books and you read the books, so we're kind of at the same level. Not the same level, but you at least understand the lingo, right? The expiration date, strike price, right? Underlying asset, the implied volatility, the Greeks, the deltas, the gammas, the thetas, and all these things you guys hopefully learned and understood a little bit, so it's not going completely over your head, right? So, but people go like, yeah, but you're saying this, but how are you deciding which option to buy? Because when I look at my option chain, there's thousands of them. There is 0 DTE options, which I think the degenerate gamblers use those. 0 DTE, 0 days to expiration. There's weekly options. There is regular expiration. I mean, there's unending options, and option trading in this country has absolutely skyrocketed. I mean, everybody and their uncle is trading options, knowing and not knowing. In fact, I put a poll up on After Hours. I said, what kind of strategies you guys use? I put up 4. And by the way, 90% of option traders lose money, or most traders lose money. And so the 4 choices were, I buy premium, meaning I buy puts and calls straight up, right? Number 2 was I sell premium. Number 3 was I do spreads, right? Put bear spreads and bull spreads. And number 4, I have no idea what I'm doing. I'm just gambling. Right? Guess what? 90% outside the I sell premium, 90%, it totaled 90%, right? So if you're buying puts and calls, fine. You're putting a directional bet and a durational bet. You need to know which ones to buy. So people go like, Serge, you should talk about that. Like, yeah, you're buying, but how you're deciding which one to buy? I'm like, okay, so today I'm going to talk a little bit about that. How to pick the right strike price and how to pick the right expiration. Well, it all depends on my time horizon. Okay. If I think a stock is going to move on a catalyst, for example, let's say earnings, right? Why would I go buy like a 6-month out option? I wouldn't. However, being a position trader or a swing trader, I always try to buy a month out regular expiration options, which expire on the 3rd Friday. So September is September 20th. Now, they have other options in between. The second thing I look at is within these next 30. So when you're buying an option, when you're buying premium, you're like spending premium, paying somebody premium, because for the buyer, there is a seller on the other side, right? So when you're buying an option, right, either you're gambling completely as a degenerate with 0 DTEs and whatever, and you can make ridiculous amount of money, but most of the time they're going to hit the wall and expire worthless. The point I'm trying to make is, what is your, then you look at the catalyst that's coming up. Do they have earnings? Is it going to move? Whatever. But then you look at your charts, right? Pictures are worth 1,000 words. So for example, the past trades, we had an amazing trade on Tesla. We had an amazing trade on AMD, right? So I was thinking Tesla, if it broke 185, will move to 220 to 240 levels within at most a month. So why would I go buy 2, 3, 4 months out options? Why would I pay more premium? Because the further you go out, the more premium you're going to pay. They're going to be more expensive. Well, sure enough, Tesla, before the crash, broke out 185. It went to 285 within less than 10 days. The options I bought for $5.25 each. So each option is 100 shares. So that's $525. Went to 28 because I wasn't buying the 185s. As far as the strike price, I was buying the 220s, which was a little bit below my target on a breakout, right? So I consider, as a position trader and a swing trader, okay, I consider what kind of move I'm expecting and how soon I'm expecting it, okay? Now, if you're buying premium, you have to be right in two things. You have to be right. You have to be right in the direction, obviously, and you have to be right in the duration. So if your setups are correct on your charts, right? If a stock has been going sideways for 4 months and on a breakout, what will happen? That's the consolidation phase. It's going to break out, move 30%. That's when you go by, decide how far of an expiration date I'm looking for and how much of an out of the money strike price I'm looking for, right? So those are the two top criteria. Obviously, I look at the Greeks. Obviously, I look at the general implied volatility. Obviously, I look at a couple different things, but you have to understand when you're buying premium, when you're just buying puts and calls, puts meaning you're betting for the stock to go down, calls meaning you're betting it to go up, you need to figure that out. You need to, look at your fundamentals and obviously look at your technicals, right? What kind of move I'm expecting, how soon, and hope that you're right. Obviously, if you buy an option expecting a 20% move in the stock, the underlying option is going to move a lot more than that. And in Tesla's case, they went from 5 to 28, the options that I bought. Okay. Did I buy it at the low, sell it at the high? No, but you guys can see how levered they are. Tesla moved $100. The options moved 5x, right? So long story short, you have to be right in the direction and you have to be right in the duration. And as a swing trader, I always look out a month out, always. If I'm going to make a directional bet, I always look a month out because the setups that I'm looking at are about to break out or break down. So on a breakdown, you buy the puts, obviously. On a breakout, you buy the calls. The strike price of an option is the price. We know what that is, right? We should be on the on the same wavelength here, right? So there is strike price, the stock price, implied volatility, in or out of the money. We should know. We should have all this lingo, okay, set up. And the good thing with buying calls or puts is limited risk. You cannot lose more than what you put up, as we know in options. So, you could be a degen gambler, buy weekly options, 0 DTE options, or you could wait for a good setup and then, my rule of thumb, again, I go out about a month out. So if I'm like right now, we're August 16th. Well, the next monthly expiration is September 20th. On the next one, I think it's October 16th. You can go September, October, November, December. You can do that. Now, if you're thinking that, well, yeah, this stock has been going sideways for a year. When it breaks out, the move is going to take about 4 to 6 months. Then you're more than welcome to go buy a 4 to 6 month out option, pay the premium, because then you can hold on to it, right? But what I do is that I still go a month out, and then there is something called a rollover. So I will buy it if the trade is working properly when I have about a week left on the existing contract. I will sell those and I will move my strike price up because stock has hopefully moved in the direction that I was hoping it would move. And then I will roll them up. I will roll them up on a month basis. But if you're not in that thought process, then you can buy a 4, 5, 6 month out option, out of the money option, right? And there's no, some people like buying at the money options because there is that much premium in it. But when you guys understand this, when you're buying an out of the money option, out of the money meaning, let's say stock is 10, and I'm buying a $15 strike price, stock has to go to 15 plus the premium for me to break even. So in that case, if the stock stays between 10 and 15, time decay is going to absolutely wipe me out, right? So you have to understand that when you buy an at the money option, your delta is going to be point for point almost from the get-go. Delta meaning how much the underlying moves and how much your option price moves. That's why you guys got to go learn the Greeks. So there is many variables, but for keeping it simple for this segment, I go usually a month out if the setup is such that I like, okay? And I go at least 3 to 4 strike prices higher because I'm expecting a big move out of that setup, okay? Or our favorite Nancy Pelosi usually buys way deep into money options because she doesn't want to pay all that extra premium, time premium. So there's two things in an option: intrinsic value, right? What it's really actually worth, and time premium. You guys have to pay attention to both. Everything you're buying out of the money on an option is time premium. There is no intrinsic value. Okay. And time, if the stock doesn't move in the direction and the duration you're hoping it will move, that option will expire worthless. That's why 90% of the people lose money trading options. So that's that. Hopefully you guys figured that out. But that's my rule of thumb. And then, determining your risk tolerance, obviously, first of all, the key is to identify a good setup. Okay. You don't have to buy and sell every single day. Don't be a hummingbird. What you can do is identify a good setup. And I've shown you guys this many, 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 many times, right? What's my best setups? Best setups are something that's been going sideways for a while. You play you buy the calls on a breakout, you buy the puts on a breakdown. So once that happens, you place your bet, you made a directional bet, and then you just hold on. And that's all I can tell you guys as far as which option to pick when. So this is my smart. I will put this on the what do you call it? On the community page on the YouTube channel. It's like videos, live, this, and then if you scroll to your right, there's a community page. I will put the current one. As of last week, it was 33.77. I got up to over 45, and I'm back to either 33 or 3,400 because I shorted the market on Thursday. I bought some puts, and they didn't die. I'm going to hold on to it, but because they're September 20th. I think the market has rallied to a point that I think we're going to have a pullback. And so now, with that said, let me go to my new charts, which I'm completely hating. I'm completely uncomfortable. And this is the new screen, people. How do you guys like it? You guys can see the screen, I hope. Welcome to my hell world. Okay, so this is the new screen. Completely different. Thinkorswim is completely different than what I'm used to. This is what they offered. I get it. I mean, I have to reset all my charts. I have to reset all my dailies, 2-minute, 10-minute, 60-minute weeklies. I don't know where to begin. And guess what? The timing of this couldn't be any worse. You know when this happened? Yesterday. I'm trying to log on to my Schwab account. It goes, "Oh, we migrated you." I'm like, bro, this is a horrible time. Why? So now I have this chart, which is completely blank. Actually, I like naked charts because if you can trade on naked charts, you can trade on anything. And as I had told you guys before, naked chart trading is the best way to do it, right? You don't have any of these indicators. I mean, although I do have MACD and RSI, which I'm going to set up. This is a candle chart. I like not point and figure. I like bar charts. I have to convert that to this. But in general, this is what happened to the market. This is hopefully I'm circling it. This is the triple Q, right? I'll go through my list and hopefully you guys will see it. I'll just go through the indexes and a couple of Mag 7s. This is the index. So this is the triple Q. Look what happened. Triple Q was hit a high of 503.50. Within 10 days or 12 days, it hit 422. That's 80 points, 80 handles, people. Okay. And it kind of pulled back into support. And then now, actually, on my big account, Schwab account, I am buying so you guys know, see, live, I'm telling you, I am buying the September 20th expiration 475 put options. I have bought 15 of them so far. I have another. This is on this good thing is on this one. It shows my orders. I have 5 more to buy if the market grinds a little bit higher here. And they're about $9.5 to $10 a piece. So 5 of them is 5K at a time. So I've put in about 15K. I'm going to put another 5K. I think the market's going to have a pullback. I mean, look, this is I talked about the carry trade, right? This is the reason I'm circling it, right? So this is the triple Qs. It's right into resistance right here, right about 475 to 477. There's a little bit more resistance at 483. If it melts up, it melts up. What do? You take a loss. But I think this will be a decent scalp for me. This is the S&P 500. I'm sorry for the charts again. I am like completely lost. And this is what had the S&P 500 did. It went from 566 to 510 and straight back to 555. I mean, think about this moves, right? This is days, people. This is like in a whole month, we went from 563 to 510, down 10%. And then literally in about 6 days, we're up from 510 to 555. We're up like 8%. I mean, these moves don't happen. This is NVIDIA. Actually, I did trade NVIDIA. I tweeted it out and I put it on my, look at NVIDIA. NVIDIA, the top was at 140, then came down to 120, back up to 136. In fact, I put an after-hour poll when NVIDIA was at 125. I said 150 or 100 first, and everybody said 150. I'm like, okay, I should do the opposite. There's always go up in the opposite. The other one was I just put a poll about maybe last week when NVIDIA was at 100. I said 120 or 80. Sure enough, everybody said 80. And then, I said, it's time to buy NVIDIA. I don't have any moving averages or anything on these, so I don't know where anything is at, but it's okay. Naked charts is actually the best way to learn. NVIDIA hit a low of 90 last Monday. Okay, last Monday. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 days. Today is the 10th trading day. We're at 125. Now, if you're trading options, you guys are going to say, Serge, in this case, what did you do? What options did you buy? Well, 10 days ago, I had bought the 110 calls literally at the open in the morning at the $1.50, $1.75, and $2. Literally by the time 6:45 came around, they had doubled already. They were 3.5. Okay. In that case, I only went out 3 weeks to buy because this was a completely short-term 2-3 day trade. Okay. So you have to understand what you're aiming for. But if you had NVIDIA options going back a year, because I don't even know how to pull these charts back, but this is a yearly chart, right? So NVIDIA was at 40, going between 40 and 50, and it broke out. When it broke out at 50, which was the setup that I like, I love these setups, right? Something's going sideways, and then it breaks out. Then it's going to go to 60, 70, 80. Then you can go buy 3-4 month out of the money options with enough time, and then you would have made a killing, right? So, and then what happened to NVIDIA? Obviously, went from 50 to 140. We all know the story. And then the massive crash, which is also partly due to, the carry trade. Let's look at Amazon. I mean, there was some massive, massive moves. If you were just active trader, you would have made a good killing, or you got killed, one or the other. Amazon went from 200 to 150 in a matter of 3 weeks. Think about this. This is a $3 trillion company, people. They're trading these stocks like pork bellies that I used to trade when I was like in my 20s. Seriously, think about this, right? And then the bounce is from 150 to 177. Apple, same thing. Apple went from 237 to 195, and then now has bounced back all the way to 225. So this is another thing that you guys have to understand. All these companies that you trust, Apple's, NVIDIA's, Google's, and all these companies, Microsoft's, right? Or Meta. When you have sales like this, 237 to 195 on Apple, to the tune of 25%, in Amazon's case, 30%, right? That's when you start DCA, your DCA account. If you like Amazon, if you liked it at 200, you got to like it at 150, unless there's a recession going on, unless something else is happening. But this was such a weird situation that's when you start your DCA, dollar cost average account, if you're going to buy individual stocks or on triple Qs or S&P 500, right? So there it is. That's all I'm going to show you guys today. If you have any chart questions, I will probably get back to this and look at it. But then I'm lost, people. I'm the most lost puppy on the planet at the moment. And let me answer some questions and we'll be done. All right, let's go all the way to the top. Okay. Good morning. Good morning. Hello from Charlotte. Yes. Queen Brown. Good morning. My first bad trade this week. So now that's saying that your first bad trade. Okay, you know what? I'll put that up. What was your bad trade? So now that's saying that is not the one you followed me on, because I'm still in there. I told you. So I don't know. You must have done something on your own. Made my first bad trade this week. So now that's saying your first. Yes, you gotta take losses. I took losses. My little Robinhood account was from 1,000 to 4,500. I lost $1,000 yesterday on it. By the time I woke up, the retail sales came out. I'm thinking this, and I have this. There you go. I had bought a few of 4 or 5, put spreads. Trashed. Like, shit happens, man. You gotta take losses. The first bad trade is your best trade is working on me. I'm just going to offset it with some good ones. Absolutely great goddamn attitude. Vic says, Sergio, on cash account, there is no day trading rule ops. Yes, there isn't. It clears the next day. I get that. But I do need a margin account also to be able to sell premium, Vic. Okay. Craig says, question. I don't know what the question is. Is not even in shape to run his house. What are we talking about here? Biden? Trump? I don't know. Okay. Queen Brown says the economy is always better under Democrats. Okay. Okay, that's questionable. And the last time we had balanced budget, yes, but it was because the administration before with the Republican House had passed the balanced budget amendment. Queen Brown. So, okay, but Clinton definitely was down the middle. It wasn't like this polarized garbage we have today with the woke crowd on one side and with the, super right wingers on the other side. This is not working out well. It's seriously not working out well. We Zoom. Good morning. So are you saying it's all manipulated? Not necessarily, but you mean the government numbers? Yes, mostly it is. Okay, you have to ask me specifics. Which link to the article? You have to ask me specifics, Weezum. Rich says, hey, Rich, when CNBC says options are expensive, what do they mean? Good question. Okay, so when about 2-3 weeks ago, when we were talking about VIX, right, volatility index, okay, there's something called implied volatility in options. Okay, so here's a question. It's not a trick question. Can an option value double without the stock moving? I'll give you guys 10 seconds to think about it. Again, can an option value, call option or a put option, can double in price without the stock moving? Yes or no? Yes is the answer. The reason is implied volatility will be moved up by the market makers, right? So when they say it's expensive, it's because the implied volatility on all options, when the VIX volatility index went from 12 to 65 in a matter of 4 days, what do you think the market makers are going to do? They're going to adjust implied volatility on every single call and put option. Okay. So that's when the option premiums go nuts. And that's when you sell premium as opposed to buy, because whatever premium you buy, you're going to die with the next volatility crush, which happened, So that's what they mean when they talk about options are expensive. Yeah. Those are the times you sell premium as opposed to buy. Expired worthless. Yeah, most 95% options expired worthless. This is my good friend from he has an amazing, by the way, which I'm looking into it, but I'm gonna join a couple of their discords. He has, I think, you know what, I don't want to misspeak. I will next week I will put this up for you guys. I'm definitely gonna pay the subscription and join it. He has a very different way of looking at the markets. So in fact, with your permission, Apple Bottom Jeans, I'm going to we DM'd yesterday. He thinks the dog is being wagged by the tail, meaning he watches gamma levels and he has a proprietary system that they watch where the abundance of option premium is on a short-term basis, and he believes that the markets are being moved towards those strike prices, if I'm not mistaken. I want to have him on as a guest for him to explain what it is. But I will put up his website. I've been reading quite a bit about it. I was under the belief after 30 years that the dog is the index, like the ETF, or let's say index meaning S&P 500 or the triple Qs. He's saying that that's not actually the dog. The dog are the option players, which by their purchases of calls or puts, because he has a way of figuring out where the money is being accumulated, where the pain points are, where massive liquidity is happening. He goes, the indexes will be moved towards those options. Now, this is a new way of looking at me. Like, again, I'm learning every day, and I'm totally willing to learn from him. And he was like, no, it's the option players who are deciding where the indexes are going to go. I'm like, that's a new way of looking at it, because that's the tail wagging the dog, because I was thinking the dog is the index and the options are the tail. He goes, no, we have a different way of looking at it. Join our Discord. And so I'm definitely doing it. So, but when I do it, I will keep you guys posted, and hopefully he'll decide to come on. WeZoom says both sides need to keep the stock float, because half of the tax receipts WeZoom are from stock sales. If the stock market tanks, there is no tax receipts. Deficits are going to go higher. Vic G, you have Thinkorswim? Bro, please save my life, bro. If you have Thinkorswim and you had it for a while, I just want to go back to what I had before, bro. You will save my life, and you will save Power Hour. I'll be eternally grateful to you, because I was thinking of calling Schwab and say, can you give me a tutorial, because I don't waste my weekend watching this shit. Okay, please, if you can, Sergio at sergioavedian.com. Email me. I swear to God, if you can help me for half an hour, I'll be eternally grateful, buddy. Okay, eternally grateful. I hate the damn thing. Well, it's probably not as bad as I'm making it out to be, but I'm so used to my own house. This house is brand new. Everything is weird, completely weird. And Apple Bottom Jeets has really enjoyed it. Yeah, it's like a little bit of trading. It's a little bit of thank you for watching. It's a little bit of macroeconomics, because they do make a big difference. Okay. Ryan Montgomery says a stock that I'm watching and trading is Taiwan Semiconductor Chips, TSM. That's the one, right? Let's take a look with my. Okay, so this is my email address. Oh my God, Vic, you will save my life. There it is. This is my email address. There you go. Boom. It's talking about, was it Taiwan Semiconductor? Yeah, that had the massive also volatility, kind of a crazy move. Can you guys see the screen? I think the symbol is TSM, right? Yeah, TSM, Taiwan Semiconductor. Look at this garbage. I can't even, bro, I need a pull down menu. I need my moving averages. And I don't even know what the hell I'm looking at. Is this the one I'm talking? Is this the one you're talking about? TSM? Yeah. Look at that thing. Look at that candle on the bottom. Okay, so that thing goes from 193 to 133 in literally 10 days, 12 days, 60 points worth. I mean, holy crap. And then it kind of is actually into support. Actually, that would have been a good purchase. Hopefully you bought around 135. And then from 133 to 173. So cumulatively, stock went from 193 to 133, 60 points, and then went back up to 173, another 40 points. So 100 points, 100-point range, let's say, cumulatively, starting on July 12th. We're August 16th, people, and take the weekends out. In 20 trading days, 100 cumulative trading points. If you guys did not make money, it's your problem. Okay, sounds good, Vic. Thank you, man. I appreciate it. Need it. So that's it. That's the questions. Hope you guys enjoyed the show. I'm gonna go back to my misery of watching. So I'm buying the September 20th expiration, regular expiration, 475 triple Q puts at around 9.5, 10. I bought 15 of them so far. I will keep buying them, and then with a stop at, probably a little bit higher. But I think volatility is back. I don't think it's going to die. I think we're going to have a lot of good back and forth here. So that's one position. Another position, let's see, what else do I have? I mean, I have a lot of different positions. I traded actually very successfully ASTS. Oh, that's another one. Serve Robotics is like right around 10. You guys need to pay attention to it. If it gets down to single digits, I think I will buy that. That's the BDI robots that I gave you guys at $2, right into 24. Although there was another one which I'll show you guys, which was an amazing, amazing move. Hold on. Okay, hold on. Can you guys see the screen? Or no? Yes, I hope so. Okay, so it was symbol is ASTS. ASTS. Damn it, it doesn't even clean it up, bro. Shit. ASTS. Look at this. Okay, look at this. This is how you do it, people. I didn't even know about this actually. $2 to today's high of 35 in a matter of, well, $2 was May 15th. Today is August 15th. This is how you do it. Yesterday, stock had already gone up from 2 to 23. Yesterday goes up another 10 points. Today goes up another, I don't know how many points, to 37 now. So there are these scanners. Hopefully, Thinkorswim has these scanners like it had with Schwab Street Smart Pro, so I can figure this shit out again. Yeah. This has options too, by the way. ASTS. I don't even know the name of the company. What is ASTS? Anyway, but I saw that on Twitter. Somebody kept tweeting it all the way from like 3 to 10. I'm going like, this guy's smoking crack. And sure enough, who's the smart one now? But there are these moves that you guys can take advantage of if you're a trader. But hopefully by next week, I will have my shit together with the help of Vic G. Thank you, Joey BTV. Much appreciated. Vic G, I'm lost, Vic. I have no idea what I'm doing. I mean, I have learned how to place orders because I place some orders. But thank you for the help. So with that said, much love. I can't thank you guys enough for the support. Please share. Please put a thumbs up. Please watch the videos. Please, listen to what I'm trying to teach, say. It's not political. It's macroeconomic stuff that you guys need to pay attention to, but you also need to pay attention to charts and Apple bottom jeans. I'm going to listen to them. I'm going to learn. Don't say can't teach an old dog new tricks. He's saying that the option traders are moving the markets. I'm going like, no, first the underlying moves and then the options move. He goes, no. Let me show you what I'm doing. I'm going like, okay. And he was one of the ones that responded to my poll on After Hours. Me and him were in the same camp. we're premium sellers. Everybody else was like, I don't know what I'm doing. I'm a gambler, degenerate gambler. The other one was I buy puts and calls and all that stuff. So he was one of the ones. So I pay attention. Okay, have a good weekend, everyone. Much love. Be safe out there. We'll see you guys next Friday with charts and more education. So be well. Thumbs up. Thanks.